Is there really a national housing market? Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome back to Rhino Invest, the financial library for young professionals. After the pandemic, the housing market boomed. U.S. home prices went up 42% over 2 years, but now that is fizzling out. Home sales are plummeting and inventory is spiking. With a potential contraction in housing prices on the horizon, you may be wondering just how much you should pay attention to the national housing market, given how different local markets can be. Today, I'll let you know. But before we jump in, if you want to get a handle on your personal finances, open an account with Rhino Invest today. By opening a Club Rhino Plus account, you will have access to a wealth of resources for financial success. From a net worth tracker to checklists, handouts, our reading list, courses, an educational portal, and a forum to speak with other rhinos. Go down to the description of this video and click on the Open an Account link. Also, please subscribe to the channel if you haven't done so already. It really helps us continue to deliver awesome content like this. All right, first off, what is the national housing market and how can it impact what you'll pay for a home? When people talk about the national housing market, they're usually referring to key statistics and trends that are used to track the health of the overall U.S. housing market. Examples of these statistics include the median price of a single-family home, the amount of home sales, and the amount of new construction. Oftentimes, economic events can impact the health of the overall housing market, which will show up in these statistics and trends. It's in this sense that the national housing market can matter for the value of your potential home. For example, when the Federal Reserve raises or lowers interest rates, it can impact mortgage rates in the housing market. If you want to learn more about how the Federal Reserve works, click the link you see on your screen right now. When mortgage rates are low, consumers are more willing and can afford to take on more debt. This increased demand can increase home prices. Higher interest rates will weaken the demand for buyers, lowering home prices. The overall health of the economy also impacts home values. Often, when the economy is sluggish, so is real estate. Government policies like tax credits, deductions, or subsidies can also boost housing demand and prices. Finally, major changes in national demographics, such as the retirement of the baby boomers, can also impact the national housing market. So while the national housing markets can certainly impact home values, if you're a potential home buyer, focusing on those national trends isn't too important. This is because prices will vary considerably between states, cities, or even neighborhoods. As they say, location, location, location. Real estate prices depend heavily on the specific market, which means that national trends can only tell part of the story. Rising national home prices won't help if your city, state, or neighborhood is in decline. Where you choose to live, whether you're deciding between which state, city, or neighborhood, has a huge impact on how much you pay for your home. Land is a finite commodity, which means that in cities where further development is difficult, like San Francisco, you'll see much higher prices. When new jobs are coming to a city and companies are offering employees higher pay, the economic strength of the city will translate into prices. A strong local economy can lead to a local housing market that has healthy demand and rising prices. On the flip side, if the local economy is weak, perhaps because of a major employer shutting shop, that can lead to a population exodus and an oversupply of properties. This will push down the demand for housing and home prices will fall. Even within the same city, prices can vary widely. Areas in which cities that are experiencing new growth can see significant price appreciation. Current and future amenities like the plans for a new school, hospital, or better public transportation and access to jobs can improve property values. On the other hand, if a sprawling city experiences a population exodus, it's often the outlying areas that suffer the most severe declines in property values. If you're in the market for a new home, you can often find local economic data through your local newspapers, state and local government agencies, and local chambers of commerce. Many local realtor associations and multiple listing services will also publish local housing market data. This research will help you understand your local housing market better. which will be more instructive for your needs than national trends. Subscribe to this channel to see more of our content and click the bell icon to receive a notification when a new video is published. Thanks for watching. Until next time, this is Cashin reminding you to seek real education, invest in performing assets, get rid of bad debt, and engage in oversight of those assets.